This is the most critical 48 hours in global finance. I need you to stop everything you are doing right now. I need you to understand that what happens in Tokyo on February 9th will determine whether your portfolio survives the next 6 months. I need you to recognize that the entire global financial system, the stock market, the bond market, the housing market, the crypto market, all of it is balanced on a knife's edge. And that knife's edge is the Bank of Japan. On February 9th, the BOJ will announce their policy decision. They will either continue printing money or they will raise interest rates. And that single decision, made by a group of bureaucrats in a meeting room in Tokyo, will trigger a chain reaction that will reshape the global economy. This is not hyperbole. This is not fear-mongering. This is mathematical certainty. Because Japan is not just another country. Japan is the keystone. Japan is the foundation upon which 40 years of global easy money has been built. And if that foundation cracks, everything collapses. Let me explain why Japan matters so much. Why a country with an economy smaller than California has the power to crash the entire global financial system. Japan has been fighting deflation for 30 years. Since the asset bubble burst in 1990, Japan has been stuck in a deflationary spiral, prices falling, wages stagnant, growth absent. And for 30 years, the Bank of Japan has done everything possible to fight it. They cut interest rates to zero. Then they went negative. They printed money, trillions of yen. They bought government bonds. They bought corporate bonds. They bought stocks. The Bank of Japan literally became the largest shareholder in the Japanese stock market. They own ETFs. They own equity positions in major corporations. A central bank acting like a hedge fund. All of this to create inflation. All of this to stop deflation. All of this to restart growth. And for 30 years, it did not work. The deflation persisted. The growth did not come. Japan remained stuck. But something changed in the last 18 months. The inflation arrived, not from domestic growth, from external shocks. The energy crisis, the supply chain disruptions, the global commodity boom, the weak yen making imports expensive. Suddenly, Japan is experiencing 3% inflation, 4%, the highest inflation in 40 years. And the Japanese people, who have lived through decades of stable or falling prices, they are panicking. Because their wages are not keeping up. Their savings are being eroded. Their standard of living is declining. And they are demanding action. They are demanding that the government stop the inflation. And this puts the Bank of Japan in an impossible position. If they continue printing money, if they keep interest rates at zero, the inflation will accelerate. The yen will weaken further. Imports will become even more expensive. The cost of living will spiral. The political pressure will intensify. But if they stop printing, if they raise interest rates, they trigger the very deflation they have been fighting for 30 years. They crash the stock market. They bankrupt the government. They destroy the economy. Because Japan's entire financial system is built on the assumption of perpetual zero rates. And when you change that assumption, when you normalize rates, the math breaks. The debt becomes unsustainable. The Ponzi scheme collapses. Let me show you the math. Japan's government debt is 240% of GDP. That is 10 trillion of debt on a $4 trillion economy. It is the highest debt to GDP ratio of any major country in the world. Higher than Greece, higher than Italy, higher than any country that is not in the middle of a war or a revolution. And the only reason Japan can service this debt is because the interest rates are zero. The government pays almost nothing in interest. But if rates rise, if they go from 0% to 1%, the interest payments increase by $100 billion per year. If rates go to 2%, another $100 billion. At 3%, Japan is spending $300 billion per year just on interest. That is more than the defense budget, more than the education budget, more than the healthcare budget. The government would have no choice but to default or print even more money to pay the interest. And printing more money creates more inflation, which forces rates even higher. It is a death spiral. And this is not theoretical. This is happening right now. The market is already starting to price in rate hikes. Japanese government bond yields are rising. The 10-year JGB yield has gone from 0% to 0.8% in the last 6 months. That might not sound like much. But in the context of Japanese finance, where yields have been pinned at zero for decades, it is an earthquake. And the tremors are spreading. Because Japanese investors, the pension funds, the insurance companies, the banks, they are looking at these rising JGB yields and thinking, why should I buy U.S. Treasuries yielding 4% when I can buy Japanese bonds yielding 0.8% with no currency risk? Why should I invest in U.S. stocks when Japanese stocks are cheaper and the yen is strengthening? The capital is starting to come home. The repatriation is beginning. And this is devastating for U.S. markets. Japan owns $1.2 trillion of U.S. Treasury bonds. They are the largest foreign holder of U.S. debt. For 30 years, Japan has been recycling their trade surplus into U.S. Treasuries, buying bonds, financing the U.S. deficit, keeping U.S. interest rates low. But now that dynamic is reversing. Japanese investors are selling U.S. Treasuries. Not massively, not in a panic, but steadily, quietly. They are reducing their exposure. They are bringing money home. And when the largest buyer becomes a seller, prices fall, yields rise. And rising yields mean higher borrowing costs for everyone. Higher mortgage rates, higher corporate debt costs, higher credit card rates. The entire U.S. economy is built on cheap credit. And cheap credit requires foreign buyers, especially Japanese buyers, to finance the debt. If Japan stops buying, if Japan starts selling, the cost of credit in America goes up. And when the cost of credit goes up, asset prices go down. Stocks fall, real estate falls, everything falls. But it gets worse, much worse. Because the yen carry trade is not just about buying U.S. Treasuries. The carry trade is about leverage. It is about borrowing yen at zero, converting to dollars, and investing in anything with a higher yield. U.S. stocks, emerging market bonds, real estate, crypto, venture capital, private equity. The yen carry trade has been the hidden source of liquidity for every risk asset in the world for the last 15 years. Every time there was a crisis, every time markets were falling, the carry trade stepped in. Japanese investors borrowing cheap yen and buying the dip, providing the bid, stabilizing prices. The carry trade was the central bank of last resort for global risk assets, but now it is unwinding. As Japanese interest rates rise, as the yen strengthens, the carry trade becomes unprofitable. The math stops working. If you borrowed yen at 0% and the yen strengthens by 10%, you lost 10% on the currency even if your investment went up. If you are leveraged 10 to 1, that 10% currency loss wipes out your entire capital. You get a margin call, you are forced to unwind, you have to sell the US stocks, you have to sell the crypto, you have to sell the real estate, you have to buy yen to pay back the debt. And when everyone does this at the same time, it creates a cascade, a liquidation spiral. Prices crash, margin calls intensify, more selling, lower prices, more margin calls. It feeds on itself. And we are already seeing the early stages. The Nikkei, the Japanese stock market, is down 8% in the last month. Japanese banks are reporting losses on their foreign currency positions. The credit spreads on yen-denominated debt are widening. The volatility in the yen is spiking. These are the warning signs. These are the tremors before the earthquake. And the earthquake is scheduled for February 9th. On February 9th, the Bank of Japan will announce their policy decision. They will either hold rates at current levels and continue their bond buying program, which would signal that they are prioritizing deflation over inflation, or they will raise rates even by just 0.25%, which would signal that they are prioritizing inflation over growth. The market is waiting, the speculators are positioned, the algorithms are programmed, and depending on what the BOJ says, trillions of dollars will move in seconds. If the BOJ holds steady, if they signal continued accommodation, the yen weakens. The carry trade gets a reprieve. Risk assets rally. Stocks go up. Crypto goes up. Everything goes up. But only temporarily, because the inflation problem does not go away. It gets worse. And the pressure builds for an even more aggressive hike later. But if the BOJ raises rates, if they signal that they are serious about fighting inflation, that they are willing to normalize policy despite the risks, the yen surges. The carry trade unwinds. The selling begins. U.S. stocks crash. Treasuries crash. Crypto crashes. Everything crashes. Because the liquidity that has supported asset prices for 15 years evaporates overnight. The Japanese money that flowed into global markets reverses, and the capital flight becomes a tsunami. And here is the cruel twist. The BOJ is trapped. They have no good options. If they do not raise rates, inflation accelerates. The yen collapses. Imported energy and food become unaffordable. The Japanese people suffer. The political backlash intensifies. Prime Minister Takaichi, who was elected on a platform of restoring Japanese prosperity, loses credibility. Her government falls. But if they do raise rates, if they normalize policy, they trigger the carry trade unwind. They crash global markets. They destabilize the financial system. And they get blamed for causing a global crisis. They are damned if they do and damned if they do not. But there is another factor that makes February 9th even more critical: the structural transformation of the Japanese economy. For decades, Japan operated on a stakeholder model. Companies existed to serve employees, suppliers, customers, the community. Profits were secondary. Shareholders were an afterthought. Companies sat on massive cash hoards. They refused to pay dividends. They refused to do buybacks. They refused to maximize shareholder value. And this led to chronic underperformance. Japanese stocks traded at 10 times earnings, while American stocks traded at 20 times. Japanese companies had return on equity of 5%, while American companies had 15%. The capital was trapped. It was not being deployed efficiently, but that is changing. Under pressure from activist investors, under pressure from the government, under pressure from a new generation of executives, Japanese companies are shifting to a shareholder-first model. They are increasing dividends. They are doing buybacks. They are selling non-core assets. They are focusing on profitability. And this is making Japanese equities attractive, very attractive. For the first time in 30 years, foreign investors are looking at Japan and seeing value, seeing growth, seeing returns. And if Japanese interest rates rise, if JGB yields become competitive, the combination of attractive equity valuations and positive bond yields will pull capital from the US back to Japan. It will be a reversal of 40 years of capital flow. And that reversal will crash US asset prices. So what happens on February 9th? Here are the scenarios. Scenario 1, the BOJ holds rates and commits to continued easing. The yen weakens. The carry trade continues. Risk assets rally, but the inflation problem gets worse. And the pressure builds for a more aggressive hike at the next meeting in April. This is kicking the can down the road. This is delaying the inevitable. And the market will see through it. The rally will be short-lived. Within weeks, maybe days, the selling will resume as investors realize that the BOJ is just postponing the crisis. Scenario 2. The BOJ raises rates by 0.25%, but signals that this is a gradual normalization, that they are data-dependent, that they will move slowly. This is the middle path, the compromise. And the market reaction will be mixed. Initial selling as the carry trade starts to unwind, but then stabilization as traders realize that the BOJ is not going to crash the system, that they are going to manage the normalization carefully. This is probably the most likely scenario, and it leads to weeks of volatility, choppy markets, no clear direction, as the market tries to figure out how fast the BOJ will normalize and how much carry trade unwind that implies. Scenario 3, the BOJ raises rates by 0.5% or more and signals aggressive normalization. This is the nuclear option. This is the BOJ saying, we are serious about fighting inflation. We are willing to accept the consequences. And the market reaction will be catastrophic. The yen surges, the carry trade implodes, margin calls everywhere, forced liquidations, flash crashes, circuit breakers, emergency central bank meetings, swap lines activated. This is the 2008 scenario. This is the global financial crisis. And while this is the least likely scenario, it is not impossible. Because Takaichi is a reformer. She is a nationalist. She's willing to endure short-term pain for long-term gain. She might decide that the only way to restore Japan is to rip the Band-Aid off, to end the easy money, to normalize policy all at once. Damn the consequences. So how do you prepare? How do you position for February 9th when you do not know which scenario will play out? First, reduce risk. If you are heavily exposed to U.S. equities, especially tech stocks, especially leveraged positions, reduce your exposure now. Take some profits. Raise cash. Do not wait until February 9th. Because if scenario 3 happens, if the BOJ goes nuclear, you will not have time to sell. The market will gap down. The selling will be so fast that you will not be able to get out at reasonable prices. Reduce your risk now while you still can. Second, diversify. Do not have all your capital in one asset class. If you're 100% in stocks, you're exposed to the carry trade unwind. If you are 100% in bonds, you're exposed to rising yields and Japanese selling. If you are 100% in crypto, you are exposed to the liquidity drain. Spread your risk. Hold stocks, bonds, cash, real estate, commodities, crypto, precious metals. Diversification is the only free lunch in investing. And in an environment where you do not know which way the market is going to break, diversification is survival. Third, watch the yen. The yen is the early warning system. If the yen starts surging before February 9th, if it goes from 125 to 120 to 115, that is the market pricing in a rate hike. That is the carry trade unwinding. That is your signal to get defensive, to reduce risk, to raise cash. But if the yen weakens, if it goes from 125 to 130, that is the market pricing in continued accommodation. That is your signal that risk assets might have more upside. The yen is the tell. Watch it closely. Fourth, consider Japanese assets. If the BOJ normalizes policy, if rates rise, if the yen strengthens, Japanese assets become attractive. Japanese government bonds at 1% or 2% yield with a strengthening currency is a better risk-adjusted return than U.S. Treasuries at 4% with a weakening dollar. Japanese equities trading at 12 times earnings with improving corporate governance is a better value than U.S. equities at 22 times earnings. If you believe that Japan is serious about normalization, if you believe that Sananomics is real, allocate some capital to Japan. Buy Japanese stocks. Buy yen. Position for the capital repatriation. Fifth, hold precious metals, gold and silver. Because regardless of which scenario plays out, regardless of whether the BOJ raises rates or holds steady, the end game is the same. More money printing, more currency debasement, more inflation. If the BOJ raises rates, they trigger a crisis. And central banks respond to crises by printing money. The Fed will restart QE. The ECB will restart QE. Liquidity will flood the system. And that liquidity will flow into hard assets, into gold, into silver. But even if the BOJ does not raise rates, even if they continue printing, that is also bullish for precious metals. Because it means the currency debasement continues. The race to the bottom continues. And gold and silver protect against that. So the trade is clear. Reduce equity exposure. Diversify. Watch the yen. Consider Japanese assets. Hold precious metals. And prepare for volatility. Massive volatility. Because February 9th is not just another policy meeting. It is the moment when Japan decides whether to continue the 30-year experiment with easy money or to end it, whether to prioritize inflation or deflation, whether to save the global carry trade or to let it collapse. And that decision will reverberate through every market, every asset class, every portfolio in the world. The Bank of Japan is the most important central bank on the planet right now, not the Fed, not the ECB, the BOJ, because they control the foundation, they control the carry trade, they control the liquidity. And on February 9th, they will decide the fate of the global financial system. Watch this date. Prepare for this date. Position for this date. Because what happens in Tokyo will determine what happens to your wealth. The countdown has begun. The clock is ticking. And the global economy is about to flip.